back to Behind the Data with me, Sam Bannister. I hope you've had a really enjoyable festive period, but the gas and power markets have certainly not had a quiet one over December, so let's have a look at what happened. Starting with gas, as we can see by the graph, this past month has been a tale of two halves really. The first half was dominated by a significantly cold spell across the UK, which saw the coldest day recorded for over a decade, and unsurprisingly this resulted in the highest gas demand in one day for over a decade. Now the UK relied on continued supply from LNG and also it lent heavily onto its internal storage to keep the system balanced. However, the market took a view of this cold spell and how the UK was reacting and put in quite a bit of risk into the front month, which you can see in the graph how it sort of starts to tick up in the beginning of December. However, as we return to milder conditions, and as we know we had a very mild Christmas and an end to 2022, this risk was priced out and we ended up losing nearly sort of over 130 pence a therm from the start of December to the end. Now, moving on to the power market, as we can see in the graph, it's a similar story to what we've just gone through with gas market. However, the cold spell brought with it not only cold weather, but a very little amount of wind. This meant at the beginning of the month, UK grid called on 2 coal power plants to start warming up because it would forecasted that it would need the additional supply. Now this call to these coal plants were actually rescinded. This was due to the UK being able to rely on France to import quite considerable amounts of their nuclear availability, and this made sure the system was balanced. However, again, this caused quite a lot of risk to be priced into the front month as sort of markets sort of took the view that it was going to be a continuing very tight supply picture into the new year. This obviously didn't materialise. The mild weather brought with it considerable amounts of wind, and this allowed for a lot of the risk that had been priced in to be unwound, coupled with French nuclear availability, which had been plagued for the back half of the summer, start to get into the realms of 40 to 45 gigawatts. Now, moving on to the oil market. As you can see by the graph, it's been a somewhat subdued month in terms of price development for oil. However, we have had some key events occur during the month, so let's have a look at what they were. Firstly, China have finally started to ease up on their COVID restrictions, which would start to open up their economy and then in doing so increase their demand for oil. This is quite significant for the oil market, as China are the highest demanding country in the world for oil. Another sort of supportive story, the EU finally agreed a cap on Russian oil at $60. Russia retaliated with banning any country that adopts this oil cap from being able to buy its oil. So again, these two stories are quite supportive of prices. However, the big overwhelming story was the market participants are quite fearful of a global recession in 2023, which obviously would reduce demand for oil considerably. And this meant that oil month on month reduced by about 4%, which is quite minimal in oil terms. Finally, looking at the carbon market, as you can see, carbon prices have moved up over the course of December. This was caused by the benchmark contract December 22 expiring. And with this expiry, market participants needed to ensure that they had enough certificates for their allocation, and therefore there was quite a lot of buying demand, and this pushed up the prices. Furthermore, the last auction for certificates occurred on the 19th of December, and this really dried up supply, so it made it hard for market participants to get new certificates. This did cause increase in prices, but over the Christmas New Year period, these sort of gains were unwound ever so slightly. So what does this mean for businesses? As we exit what has been an extremely turbulent 2022, and it looks like we're going to be entering continuation of that turbulence in 2023. However, the short-term outlook seems relatively positive. The UK has managed to get through what has been a considerable winter test relatively unscathed. We've still seen LNG coming to UK shores, coupled with the weather outlook for the next sort of few weeks to remain mild and windy, which will help with reducing gas demand and increasing power supply. However, we are still needing to get through the two typically harsher winter months in January and February, so further tests could be on the horizon. Therefore, if you've got any questions, please do contact your account manager and we'll do all we can to help you, support you through this testing market. Thank you very much, and I'll speak to you in a month's time.